Welcome to today's Explainer. We're looking at a massive, literally seismic shift in how the global artificial intelligence race is being funded, and as you'll see, the ripple effects are spreading way beyond Silicon Valley. If you've been tracking the AI space, you already know it takes just an unimaginable amount of computing power. But how is all that infrastructure actually getting paid for? Well, the answer to that is triggering a transatlantic financial domino effect that's completely reshaping global credit markets. $350 billion. Let that just sink in for a second. Over just the last 5 years, the biggest builders of AI data centers in the US have essentially doubled their debt load to hit this exact staggering mark. This isn't pocket change, and it's not spread out over thousands of companies either. It's a highly concentrated financial gamble, a massive bet that cutting-edge AI will eventually pay all of this back.
Okay, let's dive into this. Who exactly is holding this $350 billion bag? Well, it's the usual suspects: Alphabet, Amazon, Meta, Microsoft, and Oracle. Historically, these 5 tech giants have been known for totally different financial playbooks, but this desperate race for AI dominance, it's forced them all to adopt the exact same highly aggressive borrowing strategy.
And this marks a huge strategic pivot. Think about the old era of big tech. It was built on absolute mountains of cash. These companies were famous for hoarding capital. But the AI era, it's being built on debt. The sheer scale of capital expenditure you need to build out these AI data centers means that even the deepest pockets in the world have had to tap into credit markets just to fuel their empires.
Now, to put this borrowing into perspective, let's look at the actual financial realities here. Yes, their interest payments have doubled since 2019. In fact, these 5 companies paid a combined $10 billion on their debt last year alone. But keep this in mind. Google alone generated roughly $64 billion in cash flow just last quarter. So at least for now, the interest on this massive debt is almost a rounding error. They're still some of the most insanely profitable firms on Earth, easily able to absorb these costs. But when you borrow at this unprecedented scale, the market eventually starts to react.
Section 1. Market flashes, warning signs.
We're actually starting to see some cracks forming at the edges, even for these absolute behemoths. Take Amazon, for instance. Their free cash flow actually turned negative in the March quarter. Then look at Oracle. Their debt has reached roughly 2.5 times their total sales. That actually prompted S&P to cut Oracle's credit rating down to just one single notch above junk status. And they directly blamed this relentless AI spending. And you know what? The bond buyers themselves are starting to show some serious fatigue. Just look at Amazon's recent attempt to raise capital. They launched this massive $25 billion bond sale, and the reception was noticeably cool. It was the softest hyperscaler launch since Meta's offering last October. It's not necessarily that investors have lost confidence, though. It's more that they are physically running out of space in their portfolios. Traders are literally dumping older tech bonds from Amazon, Nvidia, and Oracle simply to make room for this new flood of AI debt. This growing tension is super palpable among institutional investors right now. Vishal Kanduja over at Morgan Stanley summed up the mood perfectly, saying credit risk is too undervalued right now in the market. The warning signs are stacking up and the market is officially starting to flinch. Which brings us to the most fascinating and maybe the most unexpected twist in our explainer today. Because guys, this isn't just an American story anymore.
Section 2. The European Credit Crunch. So how exactly does this play out? Well, it's basically a step-by-step domino effect. Step 1. American tech companies simply start running short of US dollars to borrow. Step 2. They cross the Atlantic and start issuing Eurobonds. Morgan Stanley expects their Euro borrowing to hit 50 billion euros this year alone. By 2026, this is going to be a core part of their funding. And step 3, because these giants are soaking up all the available capital, the cost of borrowing for everyday European startups goes up.
To really grasp the sheer scale of this, think about this comparison. If these hyperscalers hit that 50 billion euro mark this year, US big tech will become the single largest source of corporate debt in the entire Eurozone. They're on track to outborrow the entire country of France in corporate debt. That is how unprecedented American tech's footprint is in European credit markets right now. It's literally a global hunt for cash. Alphabet is the prime example here. In just a single year, Alphabet has borrowed in Japanese yen, Canadian dollars, Swiss francs, and British sterling. Actually, they were so hungry for capital, they even sold a 100-year bond. 100 years! They are scouring the entire globe to fund this AI infrastructure.
So, what does this all mean for the broader market? Well, here is the real-world butterfly effect. Imagine you're a traditional scale-up or startup in Munich or Paris. You have zero AI exposure. Maybe you're building logistics software or agricultural tech. But when American tech giants crowd into the exact same euro debt pools that these local businesses rely on, the cost of money shifts for everybody. That startup in Munich ends up paying more for their funding simply because Amazon or Microsoft got to the bank first. And that brings us to the ultimate question facing the global economy right now. Is this massive accumulation of debt a disastrous bubble, or is it a brilliant, visionary wager on the future?
Section 3. Bubble or brilliant wager?
So we basically have two dominant camps. On one side, we have the optimists, mostly the executives actually writing these checks. Amazon boss Andy Jassy states he has high confidence this infrastructure will be monetized. Mark Zuckerberg over at Meta insists that the demand for computing power just continually outstrips supply. But then on the other side of the table, you have the skeptics, particularly the credit rating agencies. Jason Pompeas from Fitch is incredibly blunt about this, calling the current environment a lot of demand hype that is very aspirational at this point. And, for anyone thinking big tech is somehow invincible, the skeptics point right to the cautionary tale sitting next door: Intel. Intel spent years loading up its balance sheet with debt, but they miscalculated and missed the AI chip boom entirely. And the result? They required a US government bailout and an investment from NVIDIA just to survive. Debt paired with the wrong technological bet can be absolutely devastating no matter how big your legacy is.
And guys, the stakes are only getting higher. One research shop estimates that the total AI debt market could explode to $7 trillion by the year 2029. $7 trillion. This AI buildout has quietly become one of the largest debt bets in corporate history.
We're already seeing the market place its bets on who can actually survive this debt load. Look at the 2026 stock performance. Alphabet is the only one in this specific group beating the market this year. Meanwhile, both Microsoft and Oracle have fallen more than 20%. The era of those massive share buybacks that used to define these tech giants, that's all but stopped, as literally every spare cent is routed straight into AI data centers. The market is getting strict, penalizing companies it feels are overleveraged.
So the absolutely crucial takeaway here is this: the gamble is no longer just a technical question of whether artificial general intelligence actually works. As we've explored today, the true wager driving these massive bond sales and offshore loans is a financial one. Europe has essentially become the staging ground where this wager gets settled. And the multi-trillion-dollar question hanging over the global economy is simply this: will the revenue arrive before the debt does? Thanks for joining me on this explainer, and definitely keep a close eye on those bond markets.